We are just past halfway through 2025, and to say it's been a dramatic year in terms of geopolitics impacting shipping would be a bit of an understatement. We've had President Trump's tariffs, fees on Chinese-built and owned ships calling US ports, conflict in the Middle East, and ongoing sanctions and war in Ukraine. Hi, it's Marcus Hand, editor of Seatrade Maritime News here. And against that backdrop of geopolitical turmoil, we are taking stock of shipping markets and where they are headed in the second half of 2025. Joining us to do this are the team from Maritime Strategies International in our regular 6-monthly discussion on the market outlook. You'll be hearing from Adam Kent, Daniel Richards, Will Frey, and Tim Smith from MSI. We'll be discussing the outlook for the remainder of the year for container shipping, dry bulk shipping, tankers, and shipbuilding. Before we drill down into those specific sectors, we'll be starting with a broad macroeconomic outlook from Adam Kent. Welcome back to the podcast, Adam.
Thank you, Marcus. Thank you for having us back.
So if you could just set the scene for our listeners of what's been happening over the last 6 months and where we're headed, I guess.
Yes, of course. Well, I mean, it's been yet another busy 6 months from a shipping market perspective, and I think there's even more moving parts now that we're having to grapple with, and these have come on top of the ones that we had at the start of the year. I think from an economy perspective, given the various sort of side, tail and headwinds, the global economy has actually faced relatively well. I think in terms of things have been stable. The US economy has remained somewhat resilient with modest GDP growth and relatively robust consumer demand. Europe has continued to grapple with sluggish growth in industrial contraction, and China's still sort of struggling with its property sector, which we've now seen for a number of years. And I think we've got to sort of thank the emerging markets, the like of India and Southeast Asia, sort of for really sort of propping up the sort of global GDP level. We have become a little bit more negative towards the second half of the year, and we expect sort of world GDP growth to come in at around 2.5% this year and potentially a little bit higher next year. But we're sort of sat in sort of a stable, low but positive growth area. Now, although that GDP appears stable at an aggregated level, there's certainly a lot going on elsewhere beneath the surface, which has been impacting the shipping markets over the course of the last 6 months. You mentioned tariffs. They have been a decisive factor since the start of the year from a number of standpoints, I would suggest. I think the uncertainty, the variability, the chaotic timings that we've seen have certainly played a part in shaping trade already over the course of the year. Shippers have either been looking to beat tariffs by front-loading, or certainly when tariffs crept up to over 140% of where they started the year off at, I think, many were looking at avoiding just calling in at China altogether. And I guess currently we're in something of a limbo territory with a lot of the tariffs put on pause till next month, which will certainly give the US administration a little bit more time to try and have an agreement with their trading partners. But I think as we've come to know and expect now from a tariffs perspective, nothing's certain. So we're not entirely sure whether that date will be cast in stone or whether things will get pushed out yet further. I think from our perspective, from a tariff standpoint, we're likely to see at least a 10% uplift on tariffs more broadly from US trading partners, and a lot more from Chinese exports into the US, sort of in the 30 to 40% above where we started the year off. So that has and will continue to have a decisive impact on trade in some shape or form. Tensions in the Middle East continue to shape the markets. I think a couple of weeks ago, we started to hear of more owners thinking about sending their ships back through the Red Sea, though events over the course of this last sort of 5 or 6 days with the Houthis once more attacking commercial shipping will have sort of no doubt put a stop to any considerations of sending vessels back through the Red Sea if those vessels were currently diverting around the Cape. And of course, in addition, over the course of the last 6 months, we've had the escalation in the conflict between Israel and Iran increase. That sort of heightened concern for shipping in and around the Strait of Hormuz, and with sort of rumours of closing off the Straits of Hormuz, sort of pushing up certainly the oil price and tanker spot rates, certainly for a short space of time. Now, tariffs haven't only been the only impact or noise that we've heard come out of the US. We've also had the USTR 301, which will potentially have an impact on Chinese-built, Chinese-owned or Chinese-operating vessels calling in at the US. And this is in addition to the Ships for Americas Act, which, although the bill has been introduced, has not come to law, but we expect to see that sort of discussions in and around that ramp up over the course of the second half of this year. I guess the final thing from a macro perspective has been the IMO's MEPC 83, which met earlier in the year, and the introduction of the midterm greenhouse gas reduction measures, with that likely to be signed off in the second half of this year and come in and implemented in 2028. So the backdrop to the shipping markets has certainly been one of change, almost on a weekly and if not daily basis. More generally, earnings have softened, I would say, for a lot of sectors of shipping. LNG earnings did reach an all-time low in Q1, especially for the older sort of steam turbine assets. Containers continue to outperform all other sectors, and that's also helped with sectors like MPPs, which have been able to ride a little bit on the coattails of the strength of the container ship market. And I think regardless of sort of general direction and momentum, most spot sector earnings have remained quite volatile, being buffeted around by all of the events that I've sort of mentioned in this sort of opening statement. So, in all, a very eventful start to 2025 with a lot of these themes we expect to continue running over the second half of the year and into 2026.
Thank you, Adam. There's a lot of different things, I think, to take into account there. In some ways, it sort of feels like the only certainty we have is uncertainty. If you're enjoying the Seatrade Maritime Podcast, make sure you never miss an episode by subscribing on the app of your choice. So I think we'll take that sort of as a base and now drill down into some of the individual sectors. And first, we'll be turning our attention to the container shipping market with Daniel Richards. And I'd like to welcome Daniel back to the podcast.
Thank you for having us back on, Marcus.
Great to have you, and I really appreciate the time you take to sort of go through the markets with our listeners. Now, it was mentioned there that containers perhaps performed a bit better than a lot of the other sectors. Could you give our listeners an overview of the container shipping market over the last 6 months?
Yes, of course. I mean, there's never a dull moment at the moment as a container market analyst. I think if I was to frame what's happened over the past 6 months, going into the year, there were, I guess, two broad sources of uncertainty and one more or less certainty that the industry was facing. The uncertainties were around what Trump would do with tariffs, which wasn't really clear at the start of the year. The next block was around the Middle East, the Red Sea, and the potential timing of carriers going back through the Red Sea. And the source of certainty was that the fleet was going to continue to expand at a pretty heady pace. In practice, what's happened is that the tariff situation has been incredibly volatile. There's been no real change to the status quo in the Red Sea, and fleet growth has been pretty elevated as expected. Now, I think if we translate that to how markets have performed, in many respects, it's actually been more stable and a kind of a less volatile year than 2024 was. And I think you can probably break the market, at least the freight markets, into two buckets. The first being the US import trades, in particular the Trans-Pacific, and then pretty much all other routes. If you look at all the other routes, in a sense, it's actually been more of a return to normality in terms of seasonal trends, in that the markets Spot markets probably started the year quite strong in the run-up to Lunar New Year, but then along pretty normal seasonal lines, markets weakened quite a lot sequentially from January, February through to April and May, and that was across the Asia to Europe trade, some of the trade into Latin America, into the Middle East. But what we've seen in the past month or so is that, in line with pretty normal seasonal trends, plus port congestion in Europe, freight markets on those routes have started to increase again. So while there's been a lot of macroeconomic, geopolitical volatility, a lot of individual container trades have actually performed as you would normally expect them to from a seasonal perspective, with the exception of the US, where there's been more of a roller coaster in relation to the timing of Trump's tariff announcements, reversals, legal injunctions, and all the whipsawing you're seeing of trade coming in and out of the US. I think it's also broadly worth noting is that, the engine of liner company profitability or lack thereof is wider average dollar per TEU pricing. And there, if you look at rates in Q1, they were down around 5% versus Q4, up around 7% year over year. And Q2 is probably going to see either a pretty stable picture compared to Q1, or perhaps even below that level. So, there has been this volatility on the US trades. Spot markets have picked up as we get into peak season, but it is overall still a relatively subdued market. And you can begin to see the fact that oversupply is having an impact just beyond the sort of volatility on individual trades.
Probably one thing I wasn't expecting you to say there was the sort of a return to normality, which is actually quite interesting. And I'd say some of what you said there, and sort of break it down into bits and go through those in terms of where we're headed in the coming months. Now, obviously, you mentioned Trump's tariffs and the sort of on-off nature of that. How do you see that impacting the market as we go through the remainder of the year?
Yeah, I mean, I'd caveat saying it's a return to normality with the likelihood that something will come along in the next 6 months to upturn that statement. But it was more that, you saw a weakening of markets as you would not often have over the first 5 months of the year, then a strengthening as we go into peak season. But as we're going into the second half of the year, yes, I mean, the tariff situation is certainly going to weigh on the US trades. We've seen US bound freight rates come off quite sharply in the past month or so, and all else equal, that seems likely to continue over the second half of this year. The status quo of the tariffs is that for trading partners who aren't China, you've got 10% tariffs in place on top of what was in place at the end of last year. That is due to continue for select economies until the 1st of August, where Trump has now unveiled a new set of reciprocal tariffs that would apparently come into place on the 1st of August. They look a lot like the list of tariffs that was unveiled in the Rose Garden on Liberation Day on the 2nd of April. Who knows whether those are going to come into force or whether the can will be kicked down the road again. With China, you currently have, relative to the end 2024 position, additional 20% universal tariffs. Those were the tariffs related to the fentanyl and border crisis that came in Q1. Those have remained in place. On top of that, you've got the 10% additional tariff. And if there isn't a deal with China in place by around the middle of August, that 10% uplift will go to 34%, leaving things about 55% above the N22 status quo. So it's a less dangerous situation than it was in that first sort of mad week of April after the Liberation Day announcements. But it is, I think, worth taking stock of the fact that average tariffs are going to be much higher than they were at the end of last year. So far, that hasn't filtered through much to overall trade growth. I think container trade volumes are in the region of around 4 to 6% up year over year so far this year. And I think with the US, though, that trade position is going to deteriorate in the second half of the year. It's hard to put a precise estimate on how much has been front-loaded into the US. There's kind of ambiguous evidence from inventories and inventories to sales ratios. But it is likely that US container trade imports are going to contract on a year-over-year basis in the second half of this year, with some weakness filtering through to the start of next year at least. And that's likely to drive rates downwards simply because the fleet keeps growing and liners are beginning to show signs of struggling of where to put all these large ships that are coming into the fleet.
Yeah, we have seen that sort of thing with people putting really, 24,000 TEU ships into West Africa, haven't we? Now, I'm going to ask you about something that I think if I'd asked you this question a week ago, I'd probably got a very different answer, and that was the potential return to the Red Sea, but that would now, I presume, be delayed.
That seems very likely. Yes, if you'd asked this 1 to 2 weeks ago, I think the state you'd said something to the effect of, well, there haven't been any attacks since the end of 2024. You're starting to see CMA CGM widen the number of services they're potentially looking to put back through the Red Sea. But that's clearly now being put on hold indefinitely. And there's no real prospect of a return to those sailings anytime soon. And we'll just have to wait and see about how that plays out. But yeah, it's a return to a very dangerous situation in that part of the world, and one that doesn't look like it will be resolved in the immediate term. And I guess we'll have to see how does the US respond again to this upswing in attacks. Clearly, there's reports that the scale of the US bombardment of Yemen earlier in the year was what drove the Houthis to come to the table and agree a ceasefire. We'll see if that dynamic recurs. But yeah, for the moment, the liner companies are not going to be resuming sailings anytime soon.
Okay, that would seem very sensible. That presumably would have something of a positive impact on the demand-supply outlook. Can you kind of give us a bit of colour on the whole sort of the order book and demand and supply going forwards?
Yeah, so the order book in particular remains large. Liner companies have continued to place new orders at a very healthy clip. We're up to around 2 million TEU of new orders placed so far this year. And that's really meant that the order book fleet ratio has remained stuck at just over 30% of the fleet, still very heavily weighted towards larger vessel segments, but there has been an uptick in ordering of smaller vessels, which is very overdue given the age profile of that fleet that we've seen in recent months. The overall picture is that without the Red Sea diversions, you'd have like an aggravated problem of allocating and finding uses for all the ships hitting the water. And it is one factor that continues to prop the markets up. We think that over a full-year basis this year, global container trade growth is probably going to come in at around 3.5% to 4%. The fleet is likely to grow by around 6.5%. What's coming forward is that we think that's going to weaken going into next year, in particular driven by the US. There's also a question of how long China can continue to export its surplus of manufactured goods to external trading partners without those piling up into inventories or inviting retaliatory trade measures from countries apart from the US. The global economy remains relatively stable, is likely to slow somewhat. So the trade outlook as we move into next year is likely to weaken, but outside of the US is unlikely to be catastrophic. There will also be a slowing of fleet growth as we move into next year, just because of the structure of the order book and the delivery schedule. But the overall point, again, is that fleet growth will substantially reaccelerate as we move beyond 2026, as orders placed in the past 18 months or so begin to leave the yard. So there's likely to be a weakening of demand-supply balance as we move into the second half of this year. We think it's one that will weigh on average freight rates as we move beyond peak season. There will be something of a respite on the supply side, but the accumulated volume of vessels that have hit the water over the past several years is going to be there in the background. And even if there's no resolution to the Red Sea crisis, it is still an industry facing potential oversupply, and we think will face actual oversupply in practice, well, at least until the next thing comes along.
Okay, so eventually sort of oversupply is just unavoidable for the sector, really.
It feels that way, but the sector has managed to avoid the worst consequences of that to a very surprising extent so far.
Indeed. So yeah, there's been a lot going on in container shipping, and we'll be, is something we'll be covering ourselves as the year moves on. I'd like to move on to look at the dry bulk market with the views of Will Frey. Will, welcome back to the podcast.
Thank you very much, Marcus. Nice to speak to you again.
Likewise, and thanks for taking the time. No, I think much as we did with the previous sector, could you start with an overview of the dry bulk shipping market over the last 6 months of the year?
Yeah, the market certainly started on a weak footing start of this year. So as we approached the end of last year, end of 2024, rates started to soften, and in January, February, things were not looking very rosy at all. But then there was a recovery through Q2, and indeed we saw Capesize spot rates spiking up to $30,000 a day, which perhaps was a little bit unexpected, the strength of that market. But overall, I think the point is that on a year-on-year basis, average earnings in dry bulk for the first half this year have been down around 25% year-on-year, and that applies to rates as they are at the moment as well. Now that the Capesize sort of spike is over and rates have dropped back to $15,000 a day, then across all benchmarks, they're down by about that amount year on year. I think if anything, that underlying fundamentals have weakened since we last spoke. And that's both from a trade perspective and a supply perspective. So this sort of recovery we've seen recently, I think we're now wondering how long this recovery will be sustained. Now, the recent spike in Capesize markets is quite revealing, really, as it tells us that despite this weaker trade volumes and a consistent throughput of new ships being delivered, then market balances are still robust enough to support these short-lived upticks. And I think that's something we can expect to continue for now, driven by short-lived trade factors. This Capesize spike was driven a lot by increased chartering activity in the Atlantic for bauxite trade as well as iron ore. And we've seen Panamax earnings start to improve a lot due to the late Brazilian soybean season, and also supported by the persistent inefficiencies in the market, such as access to the Suez Canal. Thinking of other kind of demand factors, then last time we spoke, we were talking through the impact of Chinese stockpiling of raw materials through 23, 24 in particular, and how that supported the markets. And actually, iron ore stocks have started to decline a bit in China. So maybe we'll see a kind of short-lived uptick again where China is rebuilding those stocks. So there's potential right now for some kind of short-lived spikes to live on for the near term. But I think as we head into 2026, then we see market balances weakening, and these kind of short-lived spikes will be temporary and on a downwards trend.
You say you see those short-lived spikes continuing sort of in the second half of this year. Would it be fair to say that overall, though, you expect the market to be at a lower level than it had been?
Yes, absolutely, yes. I mean, clearly rates dropped at the end of last year. It's something that that at least looking at the fundamentals of trade and ships being delivered, then that feels like a trend that might be repeated again this year, albeit by nature of these kind of short-lived spikes, you can never tell the timings of when they might happen. So, but the potential is still there, but that potential will start to decline as we go into 2026. So year on year, yes, we're expecting earnings to be weaker for dry bulk than last year.
Okay. And you did mention Chinese iron ore demand there. Is China still remaining that main engine of dry bulk?
Well, this is the sort of bit of a quandary, really, and the demand data from China is so very weak. And that's right through from a consumption perspective through to a trade perspective. So steel output's down by 1% year on year. Iron ore trade is down by about 3% year on year. And some of that is because of destocking of iron ore. Coal trade's down 5%, and coal trade is a real concern. So again, to refer back to what we talked about 6 months ago, the building of Chinese coal stockpiles has been a huge factor supporting the market. And we talked about a a kind of natural limit, or not a policy limit, let's say, where Chinese government wanted to build stockpiles equivalent to 15% of consumption, and that was essentially being reached. And since in this year, those coal stockpiles haven't really moved in any particular trend from where they've got to. So now Chinese coal demand is soft, production's been supported, they're not building stockpiles anymore, and then coal trade's down by 5%. Incidentally, in coal trade, is also a little concerning to see Indian imports declining as well, mainly because domestic production, coal India, has been very positive recently, much better than maybe 5-10 years ago, where coal India struggled to meet targets. Domestic production of coal in India has been very strong. That's dented India's import demand. So the coal trades certainly suffered not only from weak Chinese demand, but weak demand elsewhere. Yeah, we're sticking with China then on grains as well. Chinese grains imports are very soft. There was quite a good period for production in China in that sort of wheat and coarse grains group where imports this year are down by more than 50%. And meanwhile, soybeans are down by about 4%, although that's partly due to this late Brazilian export season, so that will pick up. But in each of those commodities, it's all quite negative. And it's very difficult to pick out a particular driver that will support that going forward beyond this kind of near-term soybean trade into China from Brazil, and maybe some of that iron ore restocking, and also bauxite markets, of course, have been quite positive, and we're expecting bauxite trade to grow by 7%. But those are all kind of offsetting factors behind the weaker trends in the larger commodity groups.
Not a particularly positive picture on the demand side, is it? We were talking before about with the other sectors, the various sort of geopolitical factors, tariffs, the situation in the Middle East, and so forth. How does that play into the dry bulk market?
Yeah, well, I think from a tariff perspective, the main concern for dry bulk remains that soybean trade from the US to China, depending on what China decides to do in retaliation to US tariffs. And as Dan mentioned in your discussion about containers, we're still kind of waiting for that tariff position to be sorted. And with the US soybeans exports are ramping up later in the year, then there's still time for that to be resolved or partially resolved. We're expecting some impact. So we are expecting, number one, demand for Brazilian soybeans right now to be very strong. And the Brazilian harvest is a good harvest this year. So we're expecting strong Brazilian soybean trade in the short term. And we think there's going to be some impact on US shipments of soybeans later in the year to the downside. And it won't be as bad as back in 2018 when China's swine herd had a case of African swine fever, had meant a lot of culling of their swine herd, and their demand for soybeans was lower. So that was part of the reason why soybeans trade declined so much that time around. We don't expect the same to happen this year, but still it's slightly negative. I think there's actually potentially some minor support to be had from US tariffs, in that if they're going to reduce trade from Canada, Mexico, then perhaps you might see some of those exports finding their way on longer haul routes elsewhere. So you could argue maybe some short-term positives for geared segments, but because US only imports around less than 2% of world trade, it's not really going to be a huge driver. It's more their exports that are the big concern, and of those, it's China's soybean trade that's the major risk to the downside risk to the market. Beyond tariffs, we've covered the situation in the Middle East, and that's and dry bulk markets are not isolated from that. Although, if there was bigger escalation issues in the Straits of Hormuz, then dry bulk is perhaps a sector that won't be impacted to a similar degree as what you'll see in tankers, for instance. So perhaps it's sort of isolated for some of the worst issues in that region. but it's unpredictable, and they're causing inefficiencies, and you never really tell how much disruption can really support freight markets. And so overall, I think we can say that the markets right now would be a lot weaker than they would have been without these kind of disruptions, which will looking like they will continue for now.
Okay. That's kind of worrying what the markets would look like without those disruptions. Just looking at the supply side, correct me if I'm wrong, but the order book is relatively low for dry bulk and shipping it. Does that mean that as we sort of go further out, that there could be a shortage of tonnage in a few years' time, or how does this all look?
It's a really, really good question, a very interesting question, because it's quite accepted in the market that an order book of around 10% seems to be very low. You said relatively low. And you're right in it's relatively low historically. But is it relatively low given future expectations for trade? And that we think is a question that's worth digging into, because in a world where trade and demand is flat, then an order book of around about 10% or even anything above 10% starts to appear like a bit of a threat to the market. That not undersupply, but oversupply. And the issue we have is that with China's import requirements being weaker, and if you look longer term, then I think coal trade in particular is expected to decline. And MSI, in our outlook, we're also expecting iron ore trade to decline long term, offset by some stronger trade grains, for instance, and other minor bulks. But overall, that historically strong year-on-year trade growth in dry bulk, which is supported by China's industrialization, is now shifting and changing, and we should not expect that similar rate of growth in future, in which case we should not see a order book of 10% to be kind of a low order book relatively to that forecasted demand. And really, if you look at ships being delivered this year, next year, I think previously we discussed about understanding the impact of these about 35 million deadweight new ships being delivered this year. And I mentioned previously a incremental demand of 240 million tons of cargo required to absorb that tonnage. And given the weaker trade outlook, actually we're projecting incremental trade of only 50 million tons of trade this year. And 2026 is not looking a lot better. And so you have then cumulative effects of 35 million deadweight delivered this year and something slightly higher delivered next year. And in that context, then this is certainly going to be a market that, with that outlook, would be oversupplied. So MSI is becoming more pessimistic on the market balances for bulkers next year. I think kind of longer term, then again, does this order book look oversupply, look low in that context of flat trade growth long term? And probably not. I think we would expect ordering to be more linked to the energy transition in shipping and in ordering dual fuel ships. And now we have the IMO midterm measures and putting some numbers on the rewards for, or at least the lack of penalties for using dual fuel vessels. Then we can start to plan a bit more, and we can see that maybe in the future there might be a slightly different dynamic to the order book, in that periods of scrapping of older ships is then offset by periods of contracting for new fuel efficient dual fuel vessels. And we may find in future a kind of a larger amount of contracting, a larger amount of scrapping than we had in the past, as those sort of differentials in fuel and carbon costs widen for dual fuel on modern ships versus old ships.
That's a very interesting answer to that question, actually. I think it kind of gives a lot of colour to the complexities that are involved in what's going forward. Thank you, Will. Now, I'd like to turn to the tanker market and welcome back Tim Smith to the podcast. Tim, welcome back.
Hi, Marcus. Thanks for having me. Good to be back.
Yeah, thank you for taking the time. Really appreciate it. Now, as with the other sectors, Tim, could you give us an overview of the tanker markets for the first half of the year?
Yeah, absolutely. So, yes, as with everything else, there's been a lot going on. It's been a busy first half of the year. I think the tankers just setting the scene. We saw quite a bit of downside through the second half of 2024. And Q1, as a consequence, was relatively weak. Not catastrophically so by any means, but certainly lower. And both spot markets and time charter rates were significantly lower at that point. This was in line with our expectations at MSI, so we were expecting the market to soften. Through the course of Q2, spot market certainly picked up. I'd say more limited impact from the likes of tariffs. We saw some improvement. Then across the course of Q2, things softened again. We had significant announcements from OPEC Plus in terms of production. And then in June, of course, we saw the conflict intensify in the Middle East with Israeli and then US strikes on Iran. And at that point, the markets went ballistic, essentially, certainly for sectors or routes and vessels with close proximity to that region, particularly VLCCs and larger product tankers. We saw rates skyrocket. Since then, the response from Iran to those attacks was relatively limited. The risks around, for example, the Straits of Hormuz have declined. And we've also seen, along with oil prices, tanker spot markets move down as quickly, really, as they went up in late June and are now back to levels they were kind of at close to the start of the month. And actually at relatively low levels at the moment in early July. Markets are kind of soft despite, some of that OPEC plus production increases we've seen. And that's really one of the big factors over Q2 was in April, alongside the kind of Trump tariffs and all the noise that went with that. We also saw OPEC plus decide to increase production significantly, accelerating effectively what it is the last 2.2 million barrel a day voluntary cut, effectively moving production up to reduce that cut. Their scheduled increase was about 140,000 barrels a day prior to April. They then announced around 400,000 barrel a day monthly increase and have followed on that every month since. And actually in July have accelerated that further at their latest meeting up to 500,000 barrels a day increase scheduled for August. So that's ramping up oil production and is putting pressure on oil prices. Interestingly, yet really to see that materialize in the tanker market in terms of supporting spot rates.
You mentioned the tanker market sort of went ballistic when war broke out between Iran and Israel and the close of the Straits of Hormuz, and it's now weakened significantly again. How, as an analyst, do you actually try and sort of factor in what's happening in the Middle East into your forecasts?
Yeah, I mean, it's a good question. I'll say what we do at MSI is we model markets. There's two key factors really in terms of Middle East tension. One is the Straits of Hormuz issue. The other, of course, we've touched on already, is the Suez Canal, Red Sea situation. So at MSI, we have models which we can actually adjust the availability, for example, of the Suez Canal and change how much tonnage is going through there. And our users as well on MSI Horizon can adjust that factor too to simulate different scenarios. Obviously, we can't foresee the future in terms of how these things play out, but we have what we believe to be kind of base case, high probability scenarios, which we publish. And then we and also our clients and users of MSI Horizon can change these kind of factors to see and test different scenarios in the market. So really it's about providing our clients with the scenarios and outcomes of those scenarios with our models and our reports as well.
Okay, that's interesting to learn how you actually sort of like look at that and try and factor it in. Now, coming back to what you mentioned there on the OPEC plus supply, increase in supply, how do you see the demand and supply balance going forward in the second half of this year?
So in terms of oil markets, that increase in production is interesting. It's similar in a way to what we saw around 10 years ago when OPEC Plus also made a decision to change their position from kind of supporting oil prices and restricting supply to one where they increase supply quickly. And in that period, we saw oil prices move down very quickly and tanker markets move up. The issue with that and the situation we're seeing now going into second half of 2025 is that you have to have the underlying demand to use that additional supply. Otherwise, it becomes unsustainable. And I think with other supply coming into the market from places like Latin America and also North America in particular, we're seeing potential for oil market oversupply and pressure on prices, oil prices. In the near term, that typically is positive for the tanker sector. When we typically see oil markets oversupply, it does mean more cargoes. But what happens if we don't see that underlying demand alongside is that stocks build up and the appetite for more supply weakens over time. So actually we see some downturn in markets further out. So it's kind of a bit of a kind of initial rush, and then you see a sort of hangover later on. So potentially, if we see more and more OPEC plus supply increases, we could see that kind of scenario developing. Not perhaps over the next 6 months, but over the next year or so. I mean, as I mentioned, tanker markets, actually spot rates haven't really responded too positively as yet to increases in OPEC plus supply. But we'll see potentially we'll see a bit more upside as we go through the second half of 25 and into Q4 for crude tankers. One thing just to say on the product side is really product trade has been quite weak this year, and certainly we're expecting growth in products trade to be significantly below crude. There is no equivalent OPEC plus for products, and actually on the latest numbers, we could even see products trade flatline on an annual basis versus 2024, or be weaker, because really we're not seeing the growth in that market. So yeah, potentially some short-term upside for the tanker market, but there are some issues in terms of that underlying oil demand position supporting sustained market upside.
So the second half of the year, you don't sound particularly positive, would that be? But
well, as I mentioned, we've been expecting markets to soften. We do on the supply side, which I expect we'll come to shortly, have increased in deliveries. So we're kind of expecting markets to move in the kind of range we've seen across the first half of 2025, albeit excluding the spike we saw in June from the tensions in the Middle East. So we're kind of we're not very neutral, I guess, in terms of market movement this year. Longer term, we see a bit more pressure on the market.
what is you mentioned the supply side there. What is the picture in terms of the sort of supply side new buildings coming into the market?
Yeah, so it's increasing, I think, in one word. So the tanker markets really have been on a vacation, really, from new builds coming into the market for a few years. And as a consequence, all of the disruption and volatility and upside we've seen on the demand side really has had an opportunity to be reflected in higher spot earnings, because those earnings haven't really been restrained in any way by fleet growth. But actually now we're starting to see that increase. We're going to see year-on-year increases in deliveries through 25 and into 26 as a consequence of higher ordering in more recent years. And that's going to start to play more of a role in terms of dampening the market, I think. We've also seen very high contracting in 2024. Should add that this year we've not seen those kind of levels. So that does mean there's probably going to be a cap on the kind of fleet to order book ratio. We're expecting that to kind of be at around 15% in the near term, but start to soften as a consequence of higher deliveries. So tankers aren't extremely suppressed by oversupply potential, but the supply side is going to start to make itself a bit more known in the next few years, I think, in terms of a market driver, and one that's going to be have a kind of dampening effect on conditions.
Okay, that's something to watch out for, and we'll come back and talk to you, I think, when we sort of do future episodes of the market outlook. Thank you, Tim, for taking the time to talk about the outlook for the tanker market in the second half of the year. Talking a bit there about new buildings, and with that, I'd like to come back to Adam to talk about what has been happening in the shipbuilding market. That's obviously across all sectors. Adam, perhaps you could just give our listeners a picture of the shipbuilding market in the first half of the year.
Yeah, of course. I think that the first half of the year from a shipbuilding perspective has been the same but different. Container ship contracting has continued at sort of the high levels that we have seen effectively for the last few years. And we've also seen high orders for sectors such as cruise and RoPax. But container ships have actually represented around half of all the contracts placed over the course of 2025. And for all other sectors, we've seen some big drop in volumes, as sort of Tim has alluded to on the tanker side. Tanker contracting, we think, is down by around 2/3, and bulker and gas carriers down by about 80% from where we saw them this time last year. So a huge drop-off in contracting volume so far this year. I think that obviously the geopolitical turmoil that we've talked about quite a lot on the podcast already is causing some owners to sort of sit on their hands and wait to see what actually happens. And as we've seen sort of a softening in a large number of the shipping sectors and an easing off of the new building price, I think that's also causing owners to sort of sit back and take stock rather than ordering new ships. I think from on a plus side perspective, when it comes to sort of decarbonisation, given the heavy volume of both cruise ships and container ships that have ended up at the shipyards over the course of this year, around 50% of all vessels ordered over the course of 2025 year to date have been for dual-fueled vessels. So that obviously is a positive movement towards sort of decarbonisation of the global fleet.
Okay, so I mean, overall, a lot less ordering. The container ship ordering market does seem unstoppable. Every time we seem to predict that it's going to slow up, it doesn't. I think one of the factors we've seen this year has been the whole USTR investigation into Chinese shipbuilding, and then the port fees that are coming up for Chinese-built ships and so forth, and those are owned by Chinese companies. How much impact has that actually had on ordering?
Yeah, I mean, it's an interesting point. I mean, ordering in China has fallen a lot over 2025, or the first half of 2025. Approximately a third of all orders have ended up at Chinese shipyards. Now, that compares with around 70% over the course of 2024. So a big drop in sort of orders heading to China. Now, some of that may have been driven by the USTR for sure, but I think also we have to sort of focus on where the orders have come from. And as I say, there's been a lack of dry bulk orders placed over the course of the year. And with China still being the sort of predominant builder of dry bulk vessels, I think some of the statistics are being driven by just the lack of ordering within specific sectors as much as the USTR. I think China does seem to have, there have been some tankers, there have been some container ships ordered, and China's struggled to attract those volumes. But of course, we're looking at quite small numbers of ships being ordered, and the relationship between the owner and the yard, once you start unpicking that, it may not fully be a USTR perspective, but the sort of owner-yard relationship that's partly driving the sort of move away from China. But yeah, I mean, there is uncertainty with the USTR and the port fees. And I think it is, talking to owners, it is causing owners to sort of think about whether they ought to be building in China. I think the thing is with the USTR is the directive that was initially tabled was a lot larger than the one that we have now seen come out after the consultation period. I think if the USTR has stopped at when it was announced in February and at those levels, then perhaps we'd have seen a fuller and longer sort of steer away from Chinese contracting. But realistically, the USTR is going to be penalising a lot more significantly Chinese-owned, Chinese-operated vessels rather than the Chinese-built vessels.
Okay, so it's perhaps not quite as big of a factor as you expected, although that is a big shift in terms of the ordering balance in the first half of the year. So is this good news for the Korean and Japanese yards?
Without a shadow of doubt, it is going to be good news for both the Koreans and the Japanese yards. I mean, people are going to consider the economics of building a vessel in China. We historically, Chinese vessel new build prices have been, in some cases, significantly, in others marginally below those that you'd expect to get from Korea and China, and that's predominantly been on a sort of build quality basis, certainly 10 years ago or so. I think even if an owner isn't going to trade their ship into China or isn't going to charter it out to a charterer that wants to utilize it going into US ports, I think that they will be considering that when they buy a ship, when they come to sell it in the future, whether there'll be a discount associated with having a Chinese vessel, i.e. the buyer market may be a smaller pool because the potential buyer may not want to buy a Chinese-built vessels because it does come with an economic disadvantage. So, yeah, I think that the Koreans and the Chinese yards will sort of pick up some of the pieces for those owners that want to keep options open, either trading into the US or for when they ultimately come on to sell their vessels to the wider market.
Okay, so it does sort of change the dynamic a bit. One of the other factors one of the other things we've seen at play this year has been consolidation in the Japanese market. Is that going to be enough to sort of stem the tide that sort of Japanese shipbuilding seems to have faced?
Yeah, you're right. And I guess it potentially is a little bit surprising. As you say, there's been a sort of a drawdown in Japanese shipyard capacity and Japanese shipyard output over the course of the last 10 years, realistically. And we have seen a number of announcements over the course of the year so far with regards to consolidation or investment or joint investment in yards coming out of China. Obviously, the larger yards do have, there are efficiency gains to be made. And especially as we sort of move into sort of decarbonisation world, there are, collaborations on designs and technologies also comes to the fore with larger yards. I think Imabari taking a major stake in JMU will certainly put that larger yard in a better competitive advantage. And they're both yards that sort of bringing different sort of strengths to the tables and very sort of complementary in that regard. So I think that's a positive for the Japanese market. And we've also seen the Japanese government step in. They're sort of consciously looking to try and revitalize the Japanese shipbuilding industry. They've announced a $7 billion shipyard fund and the potential establishment for a state-backed shipyard with the aim to ultimately push Japanese market share back up to sort of near 20% of global output from the sort of 10% that they're currently sitting on. So a positive move there. And I think also positive, both for Koreans and the Japanese, is that we've also seen a number of other governments around the world, most prominently India and the US, sort of come out over the course of the last 6 months with their own shipbuilding directives. And we've already seen places like Hanwha take investments in the Philly yard in the US. We've seen Hyundai sign a JV with India's Cochin shipyard. And I think increasingly, if places like the US, places like India are really going to succeed in shipbuilding, the easiest way for them to do it is to form JVs or joint ownership with yards that have originally emanated out of Korea and Japan. And of course, that's where a lot of the NACs and the DACs of the world in China have been able to succeed so well by having these JV partners with the Koreans and the Japanese.
So some potentially interesting dynamics going forward there in the actual overall market. Just to sort of round this out, what's kind of the order book outlook or new orders outlook for the rest of the year and sort of beyond that?
Generally, we think that the remainder of 2025 will sort of play out from a volume perspective in a similar manner than the first half of the year is. So our aggregate sort of contracting total for the year is around just over 60 million GT, and we've seen just over 30 million GT ordered over the first half of the year. Container ships will continue to take the lion's share of that volume, and we don't really see a huge rise in bulker, tanker, gas carrier orders in the second half of the year, because we think all of the tonnage that was going to be ordered was ordered last year, and as everyone will remember, last year was the second highest year ever for contracting volumes. We're currently forecasting contracting to drop a little bit further next year into 2026. I say this somewhat cautiously, we can't see container contracting to continue to run at the levels that we have seen it running at the course of the last few years, but admittedly, we and many other analysts have been caught out by the container ship market and just how much tonnage has been ordered over the course of the last 5 years. So you can never say never when it comes to containers, it was soon. I guess once yard prices start to soften, once we see shortening in yard lead times, when we perhaps see a bit more clarity on things like dual fuel ammonia engines and actual engines working on the water, we do expect to see an uptick in volumes. But realistically, we're sort of forecasting that to occur more in sort of the 2028 era rather than over the course of the next 20 to 24 months. And generally on the new build price side, it's something that we've been saying for some time. We did expect to see a softening in new building prices. That it has now come to fruition. If you look at a VLCC price, they've sort of dropped from around 130 million at the start of the year to sort of 125 million now. Capes have dropped from 76 million to 74 million. So we are seeing that softening in new building prices, and that was always going to happen once we start seeing deliveries outstrip contracting and sort of yard forward cover falling. The only armament that the yards have in those situations is to drop prices to try and attract sort of owners to place new orders, and we're starting to see that, and we do expect to see that having some way to run as we sort of move forward over the course of the next sort of 18 to 24 months.
Okay, thank you, Adam. Very interesting to see how all this plays out and whether the container ship engine does finally run out of steam in terms of ordering new ships. And I'd sort of like to just wrap this episode up there. There's certainly a lot of factors to take into consideration as to where shipping is headed in the second half of 2025. And we'll be following all of those markets on Seatrade-Maritime.com. And I'd like to thank Adam, Daniel, Will and Tim from MSI for their valuable insights today. And we look forward to returning to look at the markets with the team from MSI at the start of 2026.